Thank you, and congrats to the Financial Health Network on 20 years and more of impact. It's a total pleasure to join you this morning. We're going to dig in on climate change, on the climate crisis and its impacts on consumer financial health. And as we've all seen in the news, climate disasters are growing. And just to put some context around that, we're talking about record-breaking heat waves, torrential rains, flooding, storms, larger hurricanes, and longer and more intense wildfires. So to put some places on that, we're talking about flooding in Burlington, Vermont, or Hurricane Maria in Puerto Rico, or the heat dome that is over California right now, and that's all part of the same conversation. And all of these changes impact marginalized communities and the financially vulnerable more than everyone else. So it's a pleasure to dig in then here on what is happening and also what is possible as we look ahead at tools and opportunities. So it's a pleasure to join you. As you heard from the introduction, I'm Karen Weigert. I lead the Baumhart Center for Social Enterprise and Responsibility. And we actually have an MBA program focused on profit and purpose. So Business Skills for a Better World is actually central to Financial Health Network, and it's a thrill to see so many people who are putting business skills to work in that way. Now, we have three extraordinary folks up here with me to have this conversation. So I'm going to give you a quick introduction of them, and then we're going to dive in. So to my immediate right is Noreen Clancy, Senior Policy Researcher at RAND, who studies the interaction of disaster resilience and financial decision-making. Most recently, Noreen published a report focused on improving the financial resilience of public entities and individuals following natural disasters. Welcome, Noreen. Jonathan Gonzalez is the CEO and co-founder of Raincoat. Raincoat is a technology company enabling climate insurance products such as parametric insurance at scale. Jonathan founded Raincoat after seeing the devastation of Puerto Rico due to Hurricane Maria and the challenges individuals faced with insurance claims after the storm. And Leigh Peters is the president and CEO of SaverLife, a national fintech nonprofit and advocacy organization. In 2023, SaverLife published The Downpour, a research initiative intended to expose the ongoing impacts of climate change on the financial health of households living on low to moderate incomes. So you really couldn't ask for a better group for this conversation. So I'd love to really set the stage. I talked a tiny bit about some of the elements that are part of this changing climate. And as we're experiencing more of these natural disasters and more extreme weather, what are the implications of these events on individuals and their financial health? And Noreen, I'd love to start with you.
Yeah, thanks. Climate change, the frequency and severity of events we're all experiencing that. And some of that is due to climate change, and some of that is due to people and assets in more vulnerable areas. So from 1980 to 2018, so I should back up and say NOAA, the National Oceanic and Atmospheric Administration, tracks how many billion-dollar disasters there are. So from 1980 to 2018, there are about $6 billion disasters a year and an average cost of about $46 billion. In the last 5 years, from 2019 to 2023, that number has jumped from 6 to 20, and the cost has jumped from $46 billion a year to $121 billion a year. So the scale of this is just increasing. And the Census Bureau in 2022 tracked that 3.4 million people in the US evacuated due to some sort of storm. And 16% of those people never returned. And some of that has to do with their employment may have gone out of business. So businesses that are impacted by storms, 40% of those never reopen. And the Small Business Administration tracked that within 2 years of a business being impacted by a storm, 90% of those businesses fail. So this has significant impacts on individuals and communities. And communities have to think about their tax base disappearing. So even though an entire community is hit by a storm, the impacts are not felt equally across individuals. So communities of color, low-income individuals are in areas that are more susceptible to these storms and then have a harder time rebounding from them. And I think we'll get into that more later.
Absolutely. And Leigh, I'd love to pull you in and share a little bit of your research and understanding of how this is impacting individuals across the country.
So SaverLife launched our research project, The Downpour, which we're grateful to Wells Fargo Foundation for supporting that work. And we really wanted to focus on 3 core themes. We had an idea that climate change was causing economic hardship to our membership, but we didn't really know in which ways, and we weren't finding a lot of information out there. So we wanted to take a look at how frequently are people being impacted and in what ways, and how prepared do they feel that they can deal with climate impacts. Second, we wanted to look specifically at financial impacts. So we know a lot more about climate disaster and the impacts of federally declared disasters, but there are also these chronic stressors that are really showing up now in people's lives caused by more severe weather events. The third thing we're looking at is how accessible are clean energy solutions to low-income households and, across the country. So SaverLife represents about almost 700,000 people now across all 50 states. Most of our members are women, most of our members are parents, mostly people of color, and most earn below $50,000 a year. So our clients are already struggling financially. Most of them are struggling, vulnerable, or coping on the financial health score scale. So climate change really has become the ultimate threat multiplier to financial health. I cannot think of anything else I can't think of any issue, any financial issue that is not threatened by climate change. Over 70% of our members had experienced a severe weather event in the prior 12 months. On average, people had experienced 3 severe weather events. The most common was excessive heat, which again isn't necessarily considered a disaster. And what we found is that the financial impacts are actually really significant. 25% of people report missing a rent or a mortgage payment as a result of a weather disaster. 25% have fallen behind on their bills, utility bills, credit card bills. And perhaps most alarmingly, 1 in 5 are reporting loss of income. And this is in comparison to national data that was just released in the SHED report that says 4% of American households report an income loss. So that's 5 times higher for people with low incomes. And that's really destabilizing to households, communities, but also to the financial system as a whole. And if you think about, when the power goes out, as one of our members, Eliza, told us, there's no work. She works in a coffee shop. There's no power. Coffee shop's not open. You have no work. You have no income.
And I very much appreciate you mentioning heat. It is the most deadly natural disaster in the U.S., very rarely discussed in that way, and also an incredible challenge to productivity and general health. So those are examples of the physical impacts that we're seeing, but I'd love to dig in a little bit more on how do you understand who's really most vulnerable to climate change? And what are some of the challenges that are specific to a vulnerable population? And Noreen, I'd love to kick it off with you again.
So you can think about your own communities. There are certain parts of town that the lower income people live in, and some of that is historic. You can think about redlining. Certain communities have been pushed to certain areas of town, and then those areas may be places that repeatedly flood, and of course those sort of disasters put downward pressure on housing pricing. So then the prices in these locations are lower, which attracts more lower income people, and you just have this cycle of people who are lower income, people of color being kept in these areas that are really susceptible to natural hazards. And then they can't get out, right? So there are lots of communities around this country where people feel really trapped in these homes and in these neighborhoods because they can't afford to live in other parts of town. So I think that's a really interesting issue.
No, and building on that, obviously in a time of a disaster, if you're in a position where there might be some sort of payout, the timeliness is absolutely critical. And Jonathan, I'd love to make sure we bring you in and help us understand how do these disasters impact actually the receiving of financial support that might be there.
Yeah, I think one of the challenges is what we consider financial impact when it comes to climate events. So I'll give you guys an example. If I say hurricane insurance, earthquake insurance, I don't know, climate change insurance, what's the first type of insurance that most people think about? There's a really high probability that a lot of you thought about property insurance, right? Specifically houses. But the reality is that there are huge portions of the population that don't actually have any assets or any property. They rent, they live there, and as Leigh mentioned, they work, right? And what's really interesting is, as a society, we've kind of implied that the only thing that is worth insuring is property and physical assets, almost like if that whole sector of the population is immune to the event. And I'll be honest, after Hurricane Maria, most of the impact of Hurricane Maria was really financial. It wasn't really physical. There were definitely lots of houses with damage, but when it came to the broad population, the issue was, I can't work, I don't have electricity, I don't have water, I have to pay my loans, right? And then the government puts pressure on the banks in the sense of like, hey, you can't be charging interest for these things, and it becomes a really complicated financial thing. And there aren't even venues for them to request that aid because loss of income and that kind of indirect impact isn't even considered a loss or isn't sometimes even quantified in a lot of these reports. So one of the key critical aspects is really understanding that if we're talking about vulnerable populations, a lot of it is really financial rather than physical. And there are tools and things that you can implement to protect against that specifically.
Let's just dig in there. Give us an understanding. What is possible in terms of financial products that can help this population with the financial risk they're facing?
Yeah. So we've seen a lot of innovation, interestingly enough, outside of the US in markets where they've kind of hit a peak issue with people getting impacted by these events. And the way that they've been able to structure it is products that can be tied to, for example, loans or financial services that the government offers. So, for example, imagine a small business owner in Miami taking out a loan and the bank saying, hey, for an additional $20 a month, if there happens to be a hurricane, we'll forgive 6 months of payments on this loan. It's financial, right? It's not necessarily tied to property or physical assets, but rather we understand there's going to be a safety net, right, if this happens, because I want to make sure that the business stays alive, right, and actually comes back. So we've seen a lot of innovation on that side on the insurance, but it really takes kind of an innovative collective approach to think about what are you actually covering. Another interesting example that I usually reference is what happened with COVID. Instantly, right, when kind of COVID kicked in, there was no real property like damage, right, from COVID, but everyone kind of understood the implications financially that would have. So there were the PPP loans, right, and all these other programs that came up with the idea of, look, we need to support people because there's going to be significant financial disruption. For natural disasters, exactly the same thing happens, except it's worse because you also have property damage, but the financial one is hardly ever a point of discussion. And there's a lot of opportunity there to develop these products and embed them in these channels where people can interact with them.
Noreen, are you seeing examples as well?
So the one thing I was going to mention is just, I think people think, well, the government's going to come in, right? Our community just got hit by some disaster, so the government's going to come in and provide some disaster aid. Well, the first thing is, the government does not come in on the vast majority of events that happen. They only come in on these presidentially declared disasters, small fraction of the disasters that occur. So we have to come up with other things. They're not going to show up, and even when they do show up, what they pay is so nominal. This is really apparent in Puerto Rico, that it just is not very helpful. So we have to come up with other solutions, and Jonathan's company is doing something similar. There's other companies. So for example, if you are in California and you're one of the few people, let's say, that actually has earthquake insurance, the deductibles on earthquake insurance are $20,000, $30,000. So there are products that are coming in that are kind of these parametric products that as soon as an earthquake hits, it pays out, and it pays out a small amount, like $20,000, but that might help you with your deductible. And again, we're talking about property owners, so we are not talking about the most vulnerable here, but there are lots of similar products that are coming out that are not tied to property that will pay out like you have an insurance claim.
And Leigh, I'd love to get just a broader perspective from what you're hearing from your members about what their needs are in these disasters that are linked to a changing climate.
So one thing I think we need to shift our thinking is to stop thinking solely of disaster, right? Because we're talking about pervasive weather events that's showing up all year round. It's causing energy cost burden to rise, right? So the cost of energy, how much you have to heat or cool your home, how many days you have to run your air conditioning, and earlier in the year, and those energy cost burdens are really extensive, particularly for people of color and low-income communities. Similarly, with power outages and excessive heat, these things that affect people's ability to work kind of goes beyond a disaster and is more, that could go on for weeks, right? And so I think that shift in thinking to focus more on the chronic issues related to financial health in addition to disaster response. So, I think to state the obvious, the more financially vulnerable you are, the more vulnerable you are to the impacts of climate change. We did see in our research two populations that were more vulnerable than others. So the first is parents, so people who have families who have households with children in the home under age 18. Parents were 30% more likely to experience a loss of income when dealing with a climate event. The second group is renters. So they're significantly more vulnerable than homeowners. Again, 1 in 3 renters have missed payments on household bills, and 1 in 4 have experienced a loss of income. And renters are also less able to take action, right? Like they don't control their physical environment in the same way in their home in order to weatherize that home, in order to invest in clean energy solutions, and are reliant on their landlords. And so we also have to really do a better job at market segmentation and kind of really understand how these different events are affecting different populations in different ways.
Can I just pop in?
Absolutely.
Just to follow on to that, so there's been some research that has followed individuals that experienced disasters and similarly situated individuals that did not experience disasters. And what you were mentioning, like sort of falling behind on bills, your credit score drops. They followed people over a series of years, and these effects persist 3 to 5 years after the event has happened. So the effects on these sort of lower income people is really persistent.
Leigh, when you've done some of your research, is there a role for government? Noreen mentioned it a little bit, but I'd love to get your perspective too.
Yes, of course. And, we're throwing out a lot of very sobering information. And I think that, of course, makes this feel like an overwhelming issue that's impossible to tackle. But there is some reason for cautious optimism, so I'll share some of that. We are now in the early phase of a deployment of a historic investment in clean energy solutions, and billions of dollars in rebates, tax credits, and tax deductions are flowing now from the federal government to state governments to communities, through nonprofits, through the Greenhouse Gas Reduction Fund, and all of the things included in the Inflation Reduction Act. So our job now is, how do we get these resources into the hands of consumers? We just released a new report this week, and that focuses on what we call the demand gap between the types of the high demand that we see amongst our client population for clean energy solutions and the much smaller percentage of people who've actually been able to access those solutions. So what we see is that about maybe 5% of people have access to clean energy solution or have access to tax credit, but about half are really interested in doing so. And people are most interested in the things that reduce their household costs, so reduce energy costs, and improve their quality of life. So that would be home weatherization, more efficient cooling systems for their homes, more efficient air conditioning, and energy-efficient appliances. So our job now is to figure out, okay, how do we take all of this massive investment of resources and help consumers, in our case, low-income consumers, to access these types of solutions. And the challenge is that these are complex and costly purchases. This is not, something like opening a bank account or something like that, right? Like, how often have you fixed or replaced an HVAC in your house, right? Like, how often have you bought a new stove? These are things that happen very rarely in people's lives, and we need to make sure that we are meeting people with the supports they need and the financial supports. And there's a lot of great stuff coming out from the credit union movement. Kathy Mann spoke about this at the first panel on Wednesday around how can we have low-cost loan options for people, how can we transfer tax credits and deductions, how can we make sure people know about rebates, because when people make those purchases, they're going to be making a purchase based on cost, and we need to make sure that they're also able to invest in the solutions that will reduce emissions, that will reduce energy costs to households, and will increase climate resilience.
Yeah, you used some language earlier about climate essentially being a threat multiplier, which is actually the classic military way it's been described by the U.S. government. But then underlying that, there's the stresses and the shocks, and we tend to talk about the shocks a lot. The big storm is the shock. The stressors are the ongoings, the pressure to pay your bills for cooling as our summers extend. And then you get that moment where there's a solution, like there's a new product that could be in your home if you could afford it. And so there's this interesting tailwind right now of dollars coming in. And I'd love to get perspectives on what are some of the ways that you're seeing organizations create opportunities for folks to participate in solutions that support their financial health while reducing climate threats. Yeah, take it away.
So I mentioned the credit unions. There's a lot of energy and community development credit unions who are receiving funds through the Greenhouse Gas Reduction Fund to deploy as loan capital, right, to help people access. But I think we really need to make sure that the solutions we have are well designed for the people who most need them, right? So we know from all the work that we do on tax policy in our field that tax credits that are non-refundable and non-transferable are not that beneficial to households with low incomes who don't pay, who don't owe taxes, right? And a lot of the credits and things that are coming out are non-deductible, right? So you're not able to really, if you don't owe taxes, you're not going to see as big of a benefit. We're also expecting consumers to front costs and then claim these credits on the back end. So transferability, so we can have point of sale. We can have it for electric vehicles, but right now it's through auto dealers, right? So can we transfer those funds to credit unions and to other actors, community development, financial institutions who are going to be able to help communities make those purchases?
And Jonathan, I'd love to get your perspective as you think about the product suites that are out there that are part of the solution set for financial health in a climate-impacted world. Where else are you seeing movement?
So definitely, I think the insurance sector is seeing a lot of movement when it comes to the types of products that could be developed. I think we've mentioned a couple times on this panel the word parametric insurance. I'm actually super curious, just as a show of hands, how many people have actually ever heard that term before? Okay, so a very small number, that's perfectly normal.
So take it away.
Yeah. So parametric insurance is interesting because it's a little bit in the name. The intent of parametric insurance is designing insurance around specific parameters rather than a human-based kind of adjustment process. So a very common type of parametric insurance product that people interact with quite frequently, but they don't know it's parametric, is life insurance. And life insurance is parametric because there's an event, the event is very clear for everyone, and then there's a payout based on that event, right? There isn't like an adjustment process afterwards outside of just verifying that the event actually took place. So you can do exactly the same thing when it comes to climate models. You can say, well, if there's a wildfire that happens to be within 2 miles of a location, I'm going to immediately execute a payment. If there's a hurricane of a certain intensity over a location, I will give them money immediately. And one of the aspects of parametrics that's really important is just the speed of that, right? Because there's no kind of human in that loop, you can essentially execute it immediately and give people funds as soon as they need them. That's why they tie so well to financial products, because as soon as the event happens, you need the relief immediately. If you don't get the relief immediately, then the longer that takes, the worse the event is going to be. So we've seen a lot of innovation both on, for example, how do you tie these products into homeowners insurance, but also how do you create completely new categories of insurance. I'm super excited about the joining of kind of credit risk with climate impact. That's like an area that I'm personally really passionate about. And we're really seeing kind of new creative ways to get around this. And that's not even including the government side of it, right? Because you can imagine that FEMA could implement something like this where they just execute a payment instantly based on an impact rather than getting people to fill out forms and this whole process. So as technology gets more advanced, as AI, for example, gets more sophisticated, you can get much more accurate at actually detecting these events, but also being able to model them towards the future.
Yeah, and I'd love to build on that. As we think about climate impacting the entire geography of the U.S. and impacting financially vulnerable families in unique and high-pressure ways, what are some of the opportunities for banks and financial institutions to create products that can help serve these families in these times? And Noreen, I'd love to start with you.
So some of the innovation is happening at sort of the community scale and not at the institution. And Jonathan's organization is involved in this example in New York City. So there's a community-based organization, the Center for New York City Neighborhoods, and they have purchased a parametric policy in the case of a particular flooding event, and I think it's also in a particular area, right? It's a very specific area. And the thing that's really interesting about that is they've purchased it, and when the trigger happens, it's probably amount of rainfall over a certain period of time, I'm not exactly sure what it is, it triggers and it would automatically pay out. And then, so the community-based organization can then use that to serve the community, to pay out in whatever ways it sees. It might be at household levels, but it gives them a lot of flexibility. And where parametric is really different is it doesn't have that indemnification. You don't have to say, oh, here's the loss, here's all my receipts. You don't have to even experience a loss. As long as the trigger is met, it pays out. So it just cuts out a lot of that stuff that's in the middle. So that's one of the more interesting ones that we're seeing. And there's other examples of that. I'm sure Jonathan knows of many more, but that's a really interesting one that we're seeing. I would say the risk part of that is called a basis risk, is that you could pay out on this policy and it never triggers. So we've seen that in the report that I did. We document multiple examples of this. So a good example is the city of Miami, the school system bought a policy for particular wind speed. It never paid out, and so the next time they went in front of the county council to get money for this policy, again, the county council said, well, you never used it, so we're not giving you the money for that. So there is a bit of a risk, sort of the basis risk side of it.
And I think this is where you can reduce basis risk by having data. I think this is where the financial sector has an advantage. So for example, no one's currently, as far as I know, working on something like this. Would love to work on it if anyone's interested. But you have transactionary data, for example. So if you have a restaurant, right, that processes a certain amount of Visa transactions, MasterCard transactions, whatever it is, right, you can basically tell, right, if you were to normalize that data, you can actually see quite precisely moments where that business stops transacting. If you know that event, that cost, that transaction was a climate-related one, you could top that up, right, and say, look, normally as a restaurant you transact $10,000 a week. I can clearly see that that's dropped. I can clearly see that there's a heat wave. Here's a product, a financial product, that will help you deal with that situation when it happens. And there you can minimize basis risk significantly because you're measuring something that is very clear, right? It's also very difficult to fake. You can't control the climate, and you can obviously see the transactions dropping. So there's a lot of really interesting things that can be created around this space, and we're still very, very early. Just as an example, most of you here have heard about parametric for the first time today, but I really do believe that in the coming years and decades, this will become a much more normal solution, and you'll see this product in a lot of places.
I'll just say that it tends to be cheaper, or it's more affordable because the insurance company providing it doesn't have to model every potential risk. All they have to think about is you have a policy related to this one risk, which is rainfall or whatever it is. So therefore, they're able to model it better and offer it cheaper. So that's the other benefit of parametric.
And less operational expenses.
Yeah.
They don't have to
Yeah.
send anyone out.
No adjusters, all of that.
Very data-driven. Leigh, what are you seeing?
So, Jonathan had earlier mentioned the pandemic and the response to the pandemic, and I think that there's a lot to be learned there, and we have to prevent climate disaster or severe weather from becoming financial disaster, right? And the core elements of financial health also build climate resilience. There's not much difference between those two things, right? So increasing people's savings so they have that cushion, helping people have insurance, right? Insuring people against risk, renters insurance as well as homeowners insurance and other things like that. Having a good credit score, like all of these things help build climate resilience. And so if I'm gonna leave you with anything today, it will be like, that's really think about the fact that financial health is so deeply connected to climate resilience. So we have these opportunities in front of us. One is the deployment of these billions of dollars that can really help protect people and help people adapt to climate change and severe weather. We also have these risks and stressors that people are experiencing, and which we can be more flexible, as Jonathan's using as an example. How can we say, okay, we're going to give you an extra couple weeks on your credit card payment, right, with no penalty or fee, because we know that you probably had an income disruption or something else because of the weather. We used data during COVID at SaverLife to be able to see when people's incomes had dropped and to be able to send cash to people automatically, and we did that within 3 weeks at the beginning of the pandemic. So how can we use the resources that we have? But I think, I've been coming to this conference for a really, really long time. I know many of you, which is, wonderful. And I've been reflecting on some of Jennifer's comments and just some of what it means to be a part of this community. And I'll say that this is a field and a sector that knows how to collaborate. And we have collaborated across financial institutions, regulators, municipal governments, nonprofits, and other, technology companies, employers, and we've been doing this for a long time. So figure out what your role is and play that role to the best of your ability, because the worst thing you can do is nothing. And I know it feels overwhelming, so just do something. And we are here to help and to collaborate. But I think it's really important. No one gets to sit this out.
Well, ladies and gentlemen, in a time of increasing climate threats, there are also increasing opportunities for collaborations and products that can make a difference for financially vulnerable families. So I'd like to thank this extraordinary panel for our conversation today.